This year, many steel factories have been shutting down one after another, especially private ones. In places like Tangshan and Hebei, and southern regions like Guangzhou, Chongqing, and even Jiangsu, a lot of factories producing square or round pipes are really struggling. To be honest, everyone's situation is tough right now. I have a friend who ran a steel pipe factory in Guangzhou, but it went under not long ago. He invested tens of millions of yuan, and most of it went down the drain. The equipment was so depreciated that he could only sell it as scrap metal. The man in the video shows that the square pipes are mainly used in construction projects. However, due to the downturn in China's real estate market, the demand for these materials has significantly decreased, making the construction industry face even greater challenges. As a result, the production and sales of square pipes have been affected, further worsening the situation in the industry. Recently, everyone knows that the steel industry across China is in a slump. Some steel factories have started laying off a large number of workers and giving them time off, which is a situation no one wants to see. With companies unable to find a solution, employees have no choice but to find other ways to make a living. After all, they still need to support themselves. Many steel factory workers have no other option but to leave and look for jobs elsewhere, with quite a few planning to work in electronics factories. However, with foreign countries' orders for Chinese factories significantly decreasing, many factory workers are also on extended leave, making the job situation even tougher for steel factory workers who are looking for other opportunities. A video circulating on Chinese social media shows steel plates piled up on the ground inside a steel factory, many of which have already rusted. However, there are no trucks in sight to transport the goods. Recently, China's steel giant Jiangsu Delong Nickel Industry applied for bankruptcy restructuring. This not only sparked widespread attention within the steel industry, but also highlighted the significant challenges that China's current economic environment poses to traditional manufacturing. On July 24th, the People's Court of Shaanxi County, Jiangsu Province, issued an announcement stating that it has accepted the bankruptcy restructuring cases for 4 companies: Delong Nickel Industry, Shaanxi Hengsheng Stainless Steel Casting, Shaanxi Zhehe Metal Products, and Shaanxi Difeng Metal Materials. The court's announcement noted that due to the large number of creditors involved and the complex legal relationships, which have a significant impact on the region, they are now seeking a social intermediary agency through a competitive process to serve as the bankruptcy administrator for these 4 companies. Delong Nickel Industry is a stainless steel manufacturer, and its debt crisis has already troubled the global commodities industry. Public records show that Delong Nickel Industry was founded by Dai Guofeng, also known as Steel King. The company is a privately owned enterprise specializing in nickel alloy smelting, primarily engaged in the production and sale of nickel alloys. The other 3 companies mentioned are also controlled and owned by Dai Guofeng's family and relatives. According to its official website, Delong Nickel Industry employs over 8,800 workers in China and more than 10,000 in Indonesia. The company has established a full process industrial chain integrating iron making, steel making, rolling, solid solution pickling, and cold rolling. In the 2024 New Fortune 500 Wealth List, the Dai family of Delong Nickel Industry ranked 113th with a fortune of 25.5 billion yuan. On September 12th last year, the All China Federation of Industry and Commerce released the 2023 list of China's top 500 private enterprises, where Delong Nickel Industry ranked 47 with a revenue of 169.5 billion yuan. However, despite the company's factories in China and Indonesia producing over 10 million tons of stainless steel and other alloy products annually, many of its operations are being heavily impacted by the decline in nickel prices. The collapse of Delong Nickel Industry has sent shockwaves through China's metal industry, becoming yet another case in the country's ongoing debt crisis. Due to Dai Guofeng's extensive business network, hundreds of banks, wholesalers, equipment suppliers, and commodity traders, both in China and abroad, are closely monitoring this case. Shangyu, one of China's largest commodity traders, stated that its state-owned parent company, Xiamen Shangyu Group, will assume responsibility for any claims related to Jiangsu Delong Nickel Industry. However, it did not provide details on the scale of the debt transfer by its parent company. According to a report by Bloomberg, Shaanxi generated over $600 billion in revenue last year and is a trader listed on the Shanghai Stock Exchange. Delong Nickel Industry is one of its major trading clients. In a previous exchange statement, Shaanxi identified Delong Nickel Industry as its largest metals client in 2023, with transactions involving ferronickel and ferrochrome products valued at over 7 billion yuan, approximately $980 million. A report by United Credit Ratings in June mentioned that Shaanxi increased the scale of its prepayments starting in 2023 to stabilize upstream resources. As of the end of March this year, Shaanxi's debt has risen to 64.6 billion yuan, placing a relatively heavy burden on the company. In a statement, Shaanxi noted that the Jiangsu Delong Nickel Industry factory mentioned in the court documents is operating normally under government supervision. Due to Delong Nickel Industry's bankruptcy crisis, Shaanxi's stock price initially dropped by 10%, with the decline continuing and eventually reaching a 4.6% drop, marking its lowest closing price since 2020. In addition, the recent bankruptcy announcement by Shaanxi's billion-yuan steel company, Dongling Group, has also sent shockwaves throughout the industry. Reports indicate that the bankruptcy of Dongling Group will affect 18,000 employees. The bankruptcy of Dongling Group has surprised many, as the company was still widely regarded as a billion-yuan private enterprise and a member of the top 500 enterprises in China. On September 20th, 2023, Dongling Group's official WeChat account even announced it had made the list of the top 500 Chinese enterprises for the 19th consecutive year. The company ranked 205th on the list with a revenue of 125.7 billion yuan. Additionally, in the top 500 Chinese service industry enterprises list, released at the same time, Dongling Group ranked 69th. Some analysts believe that Dongling Group's bankruptcy is largely due to its deep ties with the real estate sector. Dongling Group's steel production capacity once enabled it to sell over 10 million tons of various steel products, ranking it first in sales of construction steel in China. However, real estate investment has been declining for several years. Additionally, public records show that in 2018, the group injected 1.3 billion yuan to revive the Yinhui Center project, which had been stalled for 8 years. In 2020, the group's accounts were frozen by the court due to a contract dispute with an elevator supplier, followed by another economic dispute with a construction company. According to data from Tianyan Cha, as of August 2nd, Dongling Group was facing severe legal issues, involved in 145 judicial cases covering various disputes, including sales contracts and loan contracts. The amount to be enforced has reached almost 1.3 billion yuan. Economist and new finance expert Yu Fanghui pointed out that as a large private enterprise, Dongling Group's bankruptcy will have a significant impact on the local economy and potentially on the national economy, especially affecting the upstream and downstream segments of the industrial chain. The sluggish Chinese real estate market has led to a sharp decline in domestic steel demand, causing steel producers to accumulate large amounts of unsold metal. According to estimates by Frederick Newman, HSBC's chief Asia economist and co-head of global research for Asia, real estate construction in China typically accounts for about 25% of global steel demand in a normal year. Despite the downturn in the real estate market leading to reduced demand for construction steel, Chinese steel companies have continued to maintain high production levels. Analysts suggest that this is to avoid the losses associated with shutting down blast furnaces. Nikkei Asia reports that China's steel mills now have significantly more steel inventory than distributors. Around 2020, steel inventory at Chinese steel mills and distributors were roughly equal, but now the steel mill's inventory exceeds that of distributors by 4 million tons. The profitability of Chinese steel companies is also deteriorating. According to a report by Sumitomo Corporation Global Research, the Chinese government conducted an investigation into domestic steel companies and trading firms in April this year and announced a nationwide campaign to reduce crude steel production. However, China's crude steel output in May still showed a 2.7% increase. A source from a major Japanese steel company told Nikkei Asia that, in reality, there has been no progress in reducing production. Some analysts believe that local governments in China are encouraging steel companies to maintain production levels to avoid worsening employment and financial conditions. Nevertheless, the latest performance reports from several Chinese steel companies indicate significant operational difficulties, highlighting an urgent need to expand into overseas markets. In its March performance report, Ansteel predicted that steel supply will remain at a high level throughout 2024, while demand will be weak. The company noted that domestic competition will only become more intense and that the rise of protectionism abroad and increasing international trade risks will exert certain pressure on steel product exports. Ansteel reported a net profit of 108 million yuan in 2022, but suffered a net loss of 3.25 billion yuan in 2023. According to the World Steel Association, Ansteel Group became the third largest steel producer globally in 2022. The financial report indicates that Ansteel has already begun expanding overseas. In 2023, its domestic sales revenue dropped by 15% year-on-year to 106 billion yuan, while export revenue increased by 18% to 7.2 billion yuan. Although most of its revenue still comes from the domestic market, exports were profitable overall, whereas domestic sales were operating at a loss. In its latest annual results released in March, the state-owned Ansteel Group acknowledged that the steel industry has entered a new adjustment period, with domestic competition becoming fiercer and facing protectionist policies such as tariffs abroad. Baosteel Group, the world's largest steel producer, is also looking to expand into overseas markets, seeking new sources of profit growth. Xinjiang Baiyi Iron and Steel, a subsidiary of Baosteel, stated in its performance report that the steel industry is facing unprecedented challenges. The company highlighted the pressure of a major reshuffle with the industry and warned of a severe test of survival for enterprises. Baiyi Iron and Steel primarily serves the Xinjiang market, but its operations have expanded to other provinces and regions, reaching as far as Shanghai and its surrounding areas, as well as Central Asia and Russia outside of China. Some small and medium-sized steel manufacturers have also been seeking exports as a way to escape the difficulties. State-owned Shandong Iron and Steel reported that in 2023, it exported products to Europe, South Korea, Southeast Asia, and the Americas. The company had a net profit of about 554 million yuan in 2022, but suffered a net loss of about 400 million yuan in 2023. In its annual disclosure, Shandong Iron and Steel noted that it had a small amount of exports as well. In 2023, its net profit fell by 20%, with total exports reaching 1.56 million tons, a 26% year-on-year increase. The company's key overseas markets are the Middle East and Southeast Asia. As domestic demand shrinks and inventory continues to build up, Chinese steel mills are increasingly relying on exports to reduce their stockpiles. Consequently, the excess low-cost Chinese steel is being exported to the global market. In the first half of this year, China exported 53 million tons of steel, a year-on-year increase of 24%. This year's total export volume could potentially approach the record high of 110 million tons set in 2015. According to Bloomberg, China's steel exports to Egypt surged by 95% in the first quarter of this year, while exports to the UAE also skyrocketed by 81%. The UAE has now become China's third largest steel export destination, following Vietnam and South Korea. The influx of Chinese steel has led to a deterioration in steel prices. Major steel companies have noted that, amid the significant increase in Chinese steel imports, the price of hot-rolled steel in the Southeast Asian market has dropped from $700 to $900 per ton during 2021 to mid-2022 to $500 to $520 per ton. Similarly, recent settlement prices for hot-rolled steel futures on the Chicago Mercantile Exchange have fallen from around $1,000 per ton at the end of last year to about $660 per ton. The sharp decline in international steel prices has also impacted the export of products by Japan's major steel companies. During a revenue briefing held in May, Nippon Steel Corporation stated that the decline in steel prices in overseas markets, driven by the influx of Chinese products, is expected to cause a 90 billion yen, approximately $573 million year-on-year drop in the company's revenue for the 2024 fiscal year. China's dumping of steel worldwide has had a significant negative impact on local industries. On August 7th, Huachipato, the largest and only integrated steel mill in Chile, announced that it would indefinitely suspend operations due to the increasing severity of Chinese product dumping, which has rendered the plant financially unsustainable. This decision directly affects at least 2,700 workers, and up to 20,000 jobs are indirectly linked to the plant. According to a report by AFP News, the operator Huachipato Cap Steel attributed over $500 million in losses over the past 2 years due to the massive influx of Chinese goods. Huachipato had already suspended operations in March this year, citing its inability to compete with Chinese imported steel products, which were priced 40% lower. Originally, CAP decided to shut down the plant, but later reversed course and continued production after the Chilean government imposed tariffs on certain Chinese products. More countries are now considering launching anti-dumping investigations into Chinese steel products. In the first quarter, China's steel exports to Brazil increased by 29% year-on-year, while exports to Colombia and Chile surged by 46% and 32% respectively. These three countries have already taken or are prepared to take trade measures against the import of Chinese steel to curb its uncontrolled growth. According to official Chinese data, in the 12 months leading up to February this year, China's steel exports to India increased by 84% year-on-year, reaching approximately 3 billion tons. Steel exports to Vietnam grew by 78%, reaching nearly 10 million tons. During the same period, China's exports to Turkey increased by 58%, and exports to Mexico grew by 14%. In March, the Brazilian government launched anti-dumping investigations into certain carbon steel plates and color-coded steel products from China. In September 2023, Mexico began investigating steel nails for concrete from China. Vietnam is investigating Chinese steel strands, and the Philippines is examining Chinese steel cylinders. Globally, there were 5 anti-dumping investigations targeting steel imports last year, 3 of which involved Chinese products. However, as of July this year, 14 anti-dumping investigations have been initiated globally, with 10 of them focusing on Chinese steel products. According to Bloomberg, the United States does not import much steel from China, but President Joe Biden has called for a 25% tariff on certain Chinese steel products. He is also working with Mexico to curb a flow of Chinese steel and aluminum into the U.S. through Mexico. When combined with previous tariffs under Section 301, the Trump-era Section 232 tariffs, and applicable anti-dumping and countervailing duties, this effectively means that the U.S. has almost entirely shut out Chinese steel and aluminum products. According to data from the U.S. Census Bureau, U.S. steel imports from China peaked at nearly 3 million tons in 2014, but by 2023, this figure had dropped to 600,000 tons, valued at $900 million, out of a total U.S. steel import volume of 25.6 million tons. In addition to offloading excess capacity onto international markets, Chinese steel companies are also attempting to acquire foreign steel enterprises and establish joint ventures with Chinese companies. According to a report by the Associated Press, China's Bao Steel announced plans to invest approximately $242 million to acquire a joint venture automotive steel sheet manufacturing company it established with Nippon Steel Corporation. The joint venture contract between the two companies is set to expire on July 30th. The initial purpose of this joint venture was to leverage Japan's advanced technology to capture China's vast and rapidly growing automotive market. However, as Chinese car manufacturers shift from traditional vehicles to electric vehicles, the demand for steel sheets has significantly decreased. Additionally, plant construction has lagged due to the sluggish demand in the automotive market. According to reports, after Nippon Steel sells its stake in the joint venture to Bao Steel, it will fully focus on its $14 billion acquisition of U.S. steel. Political commentator and China expert Wang He stated that the Chinese Communist Party has strategic reasons for maintaining its massive steel production capacity. It aims to play 2 cards simultaneously, one in the economic arena and the other to gain a manufacturing advantage over Europe, the US, and Japan. However, this strategy has backfired, causing significant challenges domestically and internationally. Most economists predict that China's real estate market slump will continue. This means that if steel producers do not control their production levels, they will face unsold stock for many years to come.